Massive swings and unexpected savings, the truth behind August month-end FX fix. Ready for a shock? The end-of-month London 4 p.m. FX fix in August unleashed a market impact not seen in recent months, and the numbers are shaking up expectations. Many traders and institutions lean on the 5-minute WM fix window to execute their trades, believing it's the gold standard. But here's where it gets controversial. Using the expanded 20-minute Siren FX window unlocked more than double the average savings seen just last month. Some of the world's most traded currency pairs offered their highest cost reductions in recent memory. Let's break down what really happened. On average, opting for the longer Siren FX methodology netted traders $477 per million in savings over the 5-minute WM approach, a notable jump from the annual average of $425 per million. While higher cost reductions might appear positive at first glance, the story isn't so simple. Three headline pairs, EUR-USD, GBP-USD known in the market as Cable, and USD-CHF, posted the highest savings across 9 currency pairs studied. EUR-USD, the planet's busiest FX pair, achieved a saving of $675 per million, the second biggest gain this year, trailing only May's $732 per million, and ranking third overall since the close of 2023. This mounting difference raises a key point of debate. Should market participants reevaluate how their trades are timed, and does this expose underlying inefficiencies in the traditional short window fix? Some argue that bigger savings mean bigger mispricings, contradicting the assumption that the market becomes more efficient at these key times. While certain months in 2025 saw quieter markets, the potential for savings with longer calculation windows remains strong, outpacing any average achieved in 2024. Only USD-JPY and USD-CHF have shown a dip in average savings so far this year, with USD-JPY seeing a reduction of roughly $80 per million, $409.88 per million for 2025, and USD-CHF down marginally by $13 per million, $381.75 per million for 2025. Even NZD-USD, the currency pair least affected by the fix in August, still provided a savings opportunity of $186 per million, though this marked its lowest result since September 2024. To provide further insight, savings per $1 million were projected for a range of currency pairs, using calculated correlations with fix flows. The table, not shown here, illustrates how much could have been saved at different levels of matching the market's direction, or being with the wind, as traders say. For example, at 100% correlation, meaning trades aligned perfectly with the fix flow, GBP-USD boasted a staggering $822 per million saved. Yet big moves like these often bring skepticism, especially among those wary of algorithmic or early hedging, a phenomenon that showed dramatic reversals just minutes before the fix calculation began in August. Curious about how these dynamics play out elsewhere? Each month, the full FX spotlights a new emerging market pair, offering fresh perspective. In August, USD-RON was under the microscope, 5 minutes before the WM calculation began. Heavy dollar selling sent the pair 50 pips lower. Interestingly, the sell-off didn't stop as the fix window opened, hinting that client demand outpaced the market's ability to absorb sales. This intense push, typical in WM fix events, was even sharper this month. USD-RON exited the key window at its lows only to bounce back rapidly afterward. The numbers reveal another twist. USD-RON's $793 per million potential saving was hefty, though not out of line with what was seen in 2024, yet a good $40 below the running average for 2025. Here's what's striking. This move looked genuinely driven by market needs rather than speculative plays, suggesting participants were acting on real hedging priorities instead of just chasing quick profits. And this is the part most people miss. Large savings in these windows might indicate issues lurking below the surface, like liquidity mismatches or herd behavior amplifying volatility. Should regulatory bodies, industry players, or clients push for transparency or even new methodologies to address these looming inefficiencies? Now, it's your turn. Do you see these wider savings as a sign of progress for market efficiency, or a warning flag that the FX fix remains vulnerable and outdated? Should the industry rethink its reliance on traditional fix windows? Dive in and let the debate begin in the comments. Do you agree or disagree with the direction things are heading?